Hey, it's Dave Penyuk with Revenue.com, and I've got another great tip for you. I'm going to try and be short with this one. So the tip today is your financial advisor, if you work with a financial advisor, advising you to get an investment loan? The reason I'm asking you this is because recently we were working with some joint venture partners that wanted to loan us some money that they had within their RSP account and secure it as a mortgage against one of our properties. So we would get the money and we'd be able to buy more properties, and they would have a secured investment backed by real estate, and we were going to pay them double-digit returns on it. And it all was within their RSP, which was fantastic. The problem happened when they went to talk to their financial advisor to transfer the money from the RSP account that they had set up through that financial advisor and just transferred into their own. It's called a self-directed RSP. Then they can kind of do whatever they want with it. The problem is that the financial advisor had sold them about 2 years ago on the idea of getting an investment loan. The reason that most financial advisors recommend this is you can get an investment loan for $50,000 and only pay 4% interest. But with that $50,000, I'll invest it in mutual funds, I'll invest it in stocks, I'll invest in all these different things that'll make you 10%. So you're making 10% on that money, and you're only paying 4 or 5 or 6%. So you're making 4 or 5% on that spread, that difference. But what happens when the value goes down, which many people felt over the last few years? Their $60,000 investment loan turned into about, I think it's currently worth about $50,000. They're still making those payments. The bank is still making the money on that interest, that investment loan. My joint venture partners have now lost that $10,000. And on top of all that, the bank and the financial advisor is still trading mutual funds and buying and selling funds and stocks within that $50,000 or whatever that's remaining in the value, and they still make money on that. So whose best interest does the bank have in mind when they sell you on an investment loan and when they sell you mutual funds and stocks? It's not yours in many cases. So if someone suggests to you, get an investment loan, you might want to ask twice whether or not you can actually use that money for your own investments. Because in this case, they are not allowed to sell that without paying off that loan. They're not allowed to sell their investments and take them elsewhere and invest with us. They have to keep it with the bank unless they want to pay off that loan, which is now worth more than the value of the investments themselves. So have that in mind when you're talking to your financial advisor, and I hope that's a good tip for you.